FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is 1/24/20. You know, it's amazing. January almost already gone. Is this going to be another case of the January effect? Markets go up in January, and so goes the year. Well, we'll see about that. But, you know, stock markets aren't the only thing going up. Other things are too. But first, email us with your thoughts, kl@kerrylutz.com, and what you think about the January effect. Is it real or is it imaginary? Well, like I said, the stock market indices are not the only things at record highs. So too is the FICO index. You have a FICO score, believe it or not. It was created by a company called Fair Isaacs, and it is basically judged on your credit report, enumerating the data, analyzing it, mixing in a couple of algorithms. It comes out with the odds of you defaulting within the next 18 months. And then they jumble all that up and they give it a score of roughly 500. I think that's the lowest I've ever seen, low 500s to 850. They are always monkeying with it. There's always new iterations of the index being released, but that pretty much tells you what it is. Well, Sam McElroy is with us now to discuss the significance of this, or whether it's just a rounding error. Sam, and it's good to have you back. So what about FICO scores? Is it, what exactly is it telling us?
Well, you know, I think looking at debt is one of the major components of talking about the health of personal finance. And it really is important for everybody to not only understand what a FICO score is, but how to manage debt, how to incorporate the utilization of debt or the avoidance of it in their overall plan. And I think that this is an area where there needs to be more consumer information in terms of just how debt management actually works. I think there's a lot of misinformation out there. But exactly what you were saying, it's great in a sense that FICO scores are on the rise and at record highs. But FICO scores really do tell us more about how likely you are to default. So really it's giving you an indication of how well are you managing debt. But what it doesn't tell you is basically the impact that debt may be having on your personal finances or your ability to create or sustain wealth. That's a totally different conversation. So while we're seeing record high FICO scores because people are able to manage debt a lot more efficiently these days, we're also seeing record highs in terms of volume of debt being carried, which may be detrimental in a lot of instances.
Well, if you remember, during the last president's administration, the Consumer Financial Protection Bureau, that erstwhile abomination of a government agency, started monkeying with FICO scores with their intent to drive them up and to make them a less useful indicator. Certain adverse information would not show up on your credit report if there was not a Social Security with it, whereas they used to match it, but sometimes they'd match and it would come out wrong. So what's your take here? Like, do we have artificial inflation of FICO scores?
Yeah, we may to some degree, but I wouldn't necessarily say that it's a manifestation of some of the changes that were made in, let's say, the previous administration, or we would have seen more record highs kind of at that point. I think that what we're seeing right now is that we've had a number of years, and essentially we've had, I don't know, call it 10 years plus now that we've been in a sense of expansion and growth, digging ourselves out of the subprime mortgage crisis that we had about 10 or 11 years ago. But at the same time, I think what's happening is that we're seeing that because there is lower unemployment, people that are basically employed, even though I think that we got to take that with a grain of salt, because yes, in certain areas, there's a lot of people that are still having to work multiple jobs just to be able to make ends meet. But in a sense, at least people are working. And I think that the ability to then feel more confident about the economy, to feel more confident based off of the stock market, and to have more cash flow coming in, it's allowing people to maybe recoup from things that they've had previously that was dinging their FICO scores. And now people are very much in a recovery mode where they're trying to shed debt, they're trying to repair their credit, and they're able to stay current on payments. And I think a lot of that is also helping to boost FICO scores these days as well.
Yeah. So obviously it's not purely inflation. There are people whose FICO scores have gone up in the past. One reason a lot of people were shut out after the Great Recession. They had rotten credit, they had foreclosures, bankruptcies, all that. And the effect of these incidences or events upon your credit score generally only last for 18 months. That's the way it's factored in. And charge-offs, that type of thing, they will stay on your report for a number of years thereafter, but the actual effect on your score only lasts for about 18 months to in some cases 24 months. So the fact that everybody got driven out of the credit market back 10 years ago, now their credit scores have recovered or healed, if you will.
FSN Radio. It's all about what's next.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has an excellent shareholder base with Ross Beatty owning 20%, insiders 5%, and Resource Capital Funds 8%. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
The Financial Survival Network. It's all about what's next.
Yeah, I think that that's part of it. And then I also think, we didn't really think that this was going to happen necessarily, but if we look at where we are now versus where we were 10 years ago, interest rates are actually lower right now than where they were before the subprime mortgage crisis. So the fact that the ability for people to not default on loans in a sense because of the easing of interest on the loans themselves is also making your risk of default a little bit less these days than what it might have been previously if interest rates were actually higher and it took more cost to be able to carry a loan.
Yeah. So there's a variety of factors here, some economic, some technical, some governmental, that have all kind of converged to give you a higher FICO score. You think I just read today that they're going to change the algorithm yet again. They're always tweaking it to show more divergence between people who are likely to default on their obligations and those who are unlikely to default. So there would be lowering potential defaultees scores and raising people who are unlikely. It's kind of like the unemployment rate, Sam. When you keep messing with an index, it's very hard to compare it over time, apples and oranges.
I think that is a systemic issue that's prevalent in almost every industry now, that because we keep changing the rules in a sense and changing the metrics that we're looking at, it does become increasingly harder to actually make an apples to apples comparison. You see this, I think, a lot also just in the way that financials are reported on corporations. And I think it makes it very difficult at times to really do similar valuations on companies over periods of time. And I think that the more that we continue tweaking stuff, the harder it gets to be for comparison purposes. But that doesn't necessarily mean that nothing should ever tweak or change. There's good and there's bad. Sometimes we tweak stuff because we recognize that one of the ways that some algorithm was basically playing out was artificially hindering some piece of information. And so we tweak it to try to improve it. Other times it may be politically motivated, and other times it may just be systemic. But at the end of the day, regardless of the rationale as to why some of these things get tweaked, it does still make it harder sometimes to say, well, at this point in history, here was the metric, and now today we're here, because there may be a number of other variables that changed inside of what we're now looking at.
Yeah. Yep. Agreed. So you got to have something to compare, but compare what is the question. And so you can't change it too dramatically. HUD or Fannie, Freddie, all of them, they use an older version of FICO in evaluating your loan application. So changes that are made on the public scores aren't necessarily the same changes that will be made upon your mortgage application score. So that makes it a little difficult too. There's umpteen different indices and rankings, scorings. There's the Vantage score. There's so many.
And from a personal finance standpoint, one of the things that we often tell people is that it's good to know your credit score, so to speak. A lot of things are based off of that. But one ratio that is very easy for individuals or households to track that can actually help them determine whether or not they're making progress with respect to debt is trying to keep a track of that debt to income ratio.
Yeah, they call that the DTI, right? Debt to income. Yep. And that's a key analytic on whether or not you get a mortgage. They want to see it going over 40-something%. In some ways, it's unfair. In other ways, you got to go by something, right?
That's right. Yep.
Yeah.
Yeah. So it becomes hard because then it's a question of what you consider to be income and what you consider to be debt. I mean, there's I guess gotcha is kind of in everything. I'm actually thinking about an experience that I heard a story about previously where an individual was basically trying to get a mortgage, but they disqualified their self-employment income because the P&L that they had for the year didn't match the trend for other years. So they negated the entirety of their income. And then they had some rental properties. And because the rental properties didn't have leases for a full year, they discounted that income. So it always becomes a measure of, looking at the ratios, but then ratios themselves can be manipulated also.
Yeah, well, statistics lie and liars use statistics, right? Or as someone said, there's lies, there's damn lies, and then there's statistics.
That's right. That's right. I heard somebody say once that, if you torture numbers long enough, they'll tell you whatever you want.
Yeah, and it's very true. So very true. But overall, the trend is favorable, and that is an indication that the economy is, in fact, doing well. I mean, you really can't deny that anyone who wants a job pretty much in this environment, even if you're a convicted felon and served multiple prison sentences, you pretty much can find a job here, Sam.
Yeah, to some degree, I think that's true. But I also know on the personal side, we had a number of clients, senior VPs, higher up management, stuff like that are looking for jobs, and they have been able to find one for, in some cases, I'm thinking about going on almost a year now. I think that while there's a lot of opportunity, there's still, a lot of ageism that happens. There's still a lot of, businesses trying to just make business decisions, and a lot of times they don't want to carry that higher load for a more senior exec when they can get other people in there. So I do think that as a whole, people are able to find employment. But I still think, not to paint too rosy of a picture, that there's a lot of people out there that are in jobs that they don't want to be in, or working multiple jobs, or unable to find a level of job for where their talents are. So there's still some work to be done in those areas as well.
But you do know, that's always the case in good economies or bad. Those high executive posts, they've been firing old people for 40 years now, right? Because old people cost more. They're stupid. I mean, it's a big mistake because, quite simply, the older person has more experience. They might have a less glamorous educational portfolio, but they've got more experience and more work in the real world, whereas the kid coming out of college really knows nothing, even out of business school, and what is valued. But they see, well, the pension costs are going to go up for that person. The medical costs are going to be higher. Their salaries are higher. We could hire two people for the price of that person. Goodbye. And it's kind of a shame. But on the other hand, if you just resign yourself that you're not going to be in as high an executive position as you were, you probably can find something if you aim a little lower. So what this all tells us is that the economy is full steam ahead. And till further notice, we're not looking back.
Yeah, I think the economy has a lot of strong points and is doing really well. I'm not necessarily in the boat where I would say that the economy is quite as strong as it's been purported to basically be. I think it's doing really well, but I think that there's some cracks that are emerging in the foundation that have to be corrected. And that's true of every economic period. But I think sometimes we paint this kind of on-off switch where either the economy is horrible or the economy is great. I think economies are somewhere in the middle where there's a gradation of how well they're doing. But in every instance, there's threats that have to be dealt with to try to help it continue to do well into the future. And I think that this is no different than those times.
Yeah, I think you're right. Well, in any event, Sam, we want to find out more about you, read your work on the web. Where do we go?
Yeah, so the easiest place is just our main website, which is www.atfinancial.com.
All right. Hey, we got a link to that in the show notes to this interview. Appreciate you stopping by. Questions, comments for Sam, myself. What do you think? Has your FICO score gone up? Is it going higher or is it going lower? Why don't you email us, kl@kerrylutz.com. Our Twitter feed is @KerryLutz. Our Facebook page, Financial Survival Network, and visit our home site. Sign up for our newsletter, financialsurvivalnetwork.com. Sam, as always, thanks for stopping by.
Thanks for having me.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.